Hello, fellow travelers. My name is Martin Desmond. This is part two of comparing selected Magnificent Seven stocks with selected gold mining companies. You can find the link to part one at the end of this video. In this video, I'm going to compare the PE ratios and year-to-date percentage stock price increases of Microsoft, Amazon, Tesla, and Meta against three gold mining companies. In my first video, I described a discussion that I'd had with a relative about the high price earnings ratio of Tesla compared to gold mining companies. Tesla at the end of August 2025 has a PE ratio greater than 200 to 1. For those of you who are not familiar with the price earnings ratio, it's a fairly simple ratio to understand. The price of the stock is placed in the numerator, and the earnings per share of the stock is placed in the denominator. In this example, the price of the stock is $100. The earnings per share is $10. Therefore, the price earnings ratio is 10 to 1. One of the more well-known price earnings is called the Shiller ratio. The Shiller price earnings ratio currently hovers around 39 to 1, which is near an all-time high. If there's anything that could be called normal anymore in the stock market, the PE ratio should be in the range of 15 to 1. Another famous ratio is the Warren Buffett market capitalization over gross domestic product ratio. The ratio is at 213%, which is a record high. In this video, I'm going to compare four of the Magnificent Seven stocks with three gold mining companies in regards to the gold earnings ratio. While my relative will disagree, price earnings ratios do provide one way to analyze the performance of stock. Certainly, there are a number of other financial factors that need to be analyzed, but for the sake of simplicity of this 9-minute video, I'm just going to look at the PE ratio. I'm assuming that all of you know Microsoft, Amazon, Tesla, and Meta, so I'm not going to describe any of these companies. The three gold mining companies are Gold Fields, Kinross, and Anglo Gold. These three companies have few gold mining operations in North America, but have gold mining operations in other regions of the world. In the first video, I compared more well-known gold mining companies like Newmont, Barrick, and Agnico Eagle. For those of you who are not familiar with analyzing gold-producing companies, one of the primary financial tools is to examine what is called all-in sustaining costs. All-in sustaining costs in gold mining refer to the total production costs incurred to finance the ongoing operations of a mine, including cash costs, sustaining capital, depreciation, mine reclamation, and other related expenses. It provides a comprehensive measure of the cost to produce an ounce of gold, helping investors to assess the mine's profitability and economic sustainability. Gold has certainly been moving up in price over 37% in the past year, although the price has stabilized during the summertime in the range of $3,300 to $3,500 range. This particular chart shows the price of the gold ETF, which mirrors the spot price of gold. Let's take a look at the second quarter all-in sustaining costs for these three gold mining companies. Publicly traded companies typically issue a new corporate presentation each quarter. Anglo Gold has an all-in sustaining cost of $1,666 for 2025. Anglo Gold has had a 3,287 average gold price received for 2025. Simple math shows a net profit of $1,600 for each ounce of gold produced. The company had free cash flow of 535 million and earnings before interest, taxes, depreciation of 1.6 billion. As of the end of August 2025, AngloGold has a 14 to 1 PE ratio. Kinross has an all-in sustaining cost of $1,493 for the second quarter of 2025. The company has free cash flow of $647 million. The net earnings per share has grown from 17 cents in second quarter 2024 to 43 cents in second quarter 2025, more than doubling from the previous quarter a year ago. The company has reduced its total debt from over $1 billion to $100 million in 1.5 years. As of the end of August 2025, Kinross has a 16 to 1 PE ratio. Goldfields has an all-in sustaining cost of $1,682 per ounce. As you can see on the company's second quarter presentation results, the company has generated 1.1 billion of free cash flow. The company claims to have generated 2.9 billion in shareholder value. In terms of environmental effort, the company reports a 14% decline in greenhouse gas emissions from its 2016 baseline. As of the end of August 2025, Goldfields has a 15.2 to 1 PE ratio. So, how have these four mag companies performed against the three gold mining companies in 2025? First, let's look at the PE ratios of each of the seven companies. The three gold mining companies have a surprisingly similar PE ratio ranging from 14.6 to 16.3. Our three other gold mining companies in my other video had Newmont at 13, Barrick at 16, and Agnico Eagle at 23. Notice that Microsoft, Meta, and Amazon have much higher PE ratios, with Tesla being an outlier at over 200. This next chart substitutes Tesla with the Shiller PE ratio of 39. Keep in mind that the Shiller PE ratio is near an all-time high. The gold mining companies are all extremely below the Shiller ratio. On the other hand, Microsoft, Meta, and Amazon are all within a whisper of the extremely high Shiller PE ratio. As a disclosure, I do own stock in gold mining companies, but the amount is so small that if I were to sell all the stock at the same time, that there would not even be a blip upon a blip in the stock market. Here is a 2025 year-to-date stock percentage increase chart of the four mag companies and the three gold mining companies. The big winners are the three gold mining companies, with each of the companies easily doubling in price year to date. Meta and Microsoft have relatively decent percentage increases of 23 and 20% year to date, respectively. Amazon is barely showing a 4% increase, while Tesla is showing a loss. Stocks certainly go up and down, so one cannot necessarily look at just an 8-month period of time. However, if the price of gold stays steady in the range of 3,300 to 3,500 for the next year, and the gold mining companies are able to keep their all-in sustaining costs in the range of $1,600 to $1,700, these companies will be essentially printing money. The big question is whether the stock market will return to the long-term average of PE ratios somewhere in the range of 10 to 1 to 15 to 1. As many commentators have noted, stocks can stay out of balance for much longer than you would expect. Thanks for listening to the end. Please hit the like button and subscribe. You can click on the link above to watch my part 1 that covers the three mag companies and the three other gold companies. Thanks again.